So let's get started talking about the basics of technical analysis. Now, everywhere I go, whether I'm giving a seminar, one-on-one presentation, whether I'm at a conference, even if I go to the office, people are always asking me, what should I buy today? What should I sell? What will prices be tomorrow, next week, or even next year? Now, wouldn't investing or trading be easy if we knew the answers to these simple questions? But alas, I don't have a Ouija board and I don't have a crystal ball. So if you're attending this class in the hopes that technical analysis has the answers to these questions, I'm afraid I have to disappoint you early. It does not. However, if you're attending this class with the hope that technical analysis will improve your trading and investing, that it surely will. So the first question is, and it's a very important question, what is technical analysis? Because a lot of traders assume technical analysis is very complex. It's very involved. They assume it's all of those mathematical indicators and oscillators we place on charts. But it isn't. That's like one small sector of this scary field, of the scary science we call technical analysis. So to make it less scary, I virtually don't use the word technical analysis. I call it chart analysis, because the basic explanation of what is technical analysis, it's anything and everything we do on a financial chart. Now, sure, you can look up indicators and oscillators by doing the mathematical calculation and have a number. But unless you put it on your financial chart, it doesn't make any sense to you. So we can think of technical analysis as a sort of framework that traders use to study and make use of price movements of a market. Now, technical analysis focuses exclusively on the study of price charts and trading history to determine future price movements. So, as I said, I call technical analysis chart analysis. Technical analysis is anything you do on a price chart. Now, the primary reason that traders use technical analysis is to make predictions about future price movements based on past price movement. Now, that sounds like that's a bunch of hocus pocus, but it really isn't. Technical analysis, technical analysts believe that all current market variables are reflected via the price movement or price action on a chart. So if we believe that all market variables are reflected in the price movement, it only goes to reason that we don't really need much else to analyze and trade the markets besides price. Now, I, as a trader, am a technical analyst. And so are most of the members of my trading community. We prefer technical analysis because we agree with the idea that all market variables are reflected via price action. So we see no reason to use other means to analyze or trade the markets. But that's not to say that we don't have a knowledge of the fundamentals and news events. Ignoring other things and other features and other types of is just pure stupidity. But we just don't rely on them heavily. But we don't ignore the fundamentals. Now, if you were to say, hypothetically, that gold has been trading upward, I have no idea where gold is trading today. But if we can see that gold is at 16 and moved up to 1610, up to 1620, up to 1630, and we might want to try to figure out not where the trend would stop, not even how high gold would go. If we wanted to figure out what price in this latter movement would be a crucial price to help us determine whether gold was going to have the momentum to continue going up, or whether gold was about, not going to collapse, but gold didn't have the effort to go farther. Well, if we go back and look and see what price was important to gold. The last time gold was coming near this price, we could then say, look at that. The last time gold was going from 1610 to 1620 to 1630, it got stuck at 1650, couldn't get through it and fell back down. And then we saw that it bounced back up and went to 1648 and couldn't reach 1650. It bounced off the 1649 and couldn't break 6. It eventually broke 1650 and went up. But we now know that 1650 and 1647, 48, 49 is a crucial price level for gold. If we went back and looked at it the time before when it was progressing up, maybe we could see that 1648 and 49 was more important. We go back the last time gold was going through there, maybe it was 1650 and 1651. But now we know historically gold has always had a problem or got stuck. Not saying it didn't climb up farther, but got stuck or reacted at 1650. Well, we know 1650 is a volatile level, an important level that we could expect some type of clue as to what was going to happen at gold. We might set our take profit point at 1650. We might decide we want to buy, but only when gold has broken the 1650 level. If we were in an asset and we have been gold since 1610, maybe we wanted to get out of gold or sell half of our contract as it close to 1650 range. Okay. But we knew that 1650 was important. Now, technical analysts also encompass learning to analyze the market structure. We look to find trends, support and resistance levels, and generally to learn to read the ebbs and flows of the market. There is obviously discretion involved here. And I'll be the first person to tell you that technical analysis is more of an art than it is a science. But the more you practice it, the better you get. So let's go over and let's talk about, let me pop up a live chart here for you. Okay. Now, we're looking at my Euro US dollar teaching chart. Got lots of funny little lines all over the place. And it's got price action on it. We see an indicator down below. Well, these lines above, we're going left horizontally, are my support and resistance lines. These are my steps on my ladders as prices got up and down through this level where it is right now. And we've been through the 16, 19, 16, 18, 16, I'm not 16, 118, 119, 120 level with the Euro US dollar a lot lately. And we've seen historically that every time it gets close to 60 to 120, it bounces and eases back down and eases back down to 116 and then eventually moves up. And we go back and we can go back farther and farther on our charts. And we can see all the times that has moved up in this range and what has happened at that range. So by looking at price on the chart, I'm just trying to get back. Okay. We know where my red line is, my price level here at 118 is strategically important. We also know this level 118.11 has been strategically important. We saw this huge big candle here, and we see price above that. What we're doing is we're applying technical analysis. We're looking at price. We're reading a chart and trying to understand price action. Now, there are many, many ways we can do that. We don't need to use oscillators and indicators. We can use just reading candlesticks is technical analysis. Just using support and resistance is technical analysis. Applying a trend line is technical analysis. Now, there are some basics of technical analysis that we should always be using. And one of the reasons charts are so important is if I were to tell you that the euro US dollar was trading at 118.11, and it bounced up to 118.29, then went up to 118.37, came back down to 118.19, and went back up to 118.29, and then came back down to 118.11. Could you repeat that to me? Could you actually tell me what the euro US dollar did over the last 2 hours? No. But if I were to put that on a chart, you could visually comprehend. So charts help us see the graphic depiction of price, and it gives us something our minds can comprehend. Remember that old saying that we still use all a picture's worth 1,000 words? Well, so was a chart. Now, these lines and price charts are part of technical analysis. They're just not technical indicators. Then there's another whole field of study called chart patterns. And what I am a pattern trader. Okay. Now we have under these patterns, we have things like double bottoms and bull flags and bull pennants and ascending wedges and descending wedges and triple tops and bear flag and inverted cup and ham. Now, these I didn't make up. These are standard patterns that repeat and repeat and repeat in the market over and over and over and over again. We see them continuously. Now, I happen to be a triangle trader. Okay, it's my thing. I trade triangles and support and resistance. That's it for me. Okay. But that doesn't mean you have to be. But again, this is all the field of study of technical analysis. So I just want to go back over to my PowerPoint. So that said, it is something you will get more comfortable with and better in a given time with time and practice. Technical analysis forms the backbone of my core trading method of price action, which is simply a derivative or an offshoot of traditional technical analysis, except with more clarity and more concise strategies that don't involve confusing indicators and things like Elliott wave theory that are far more messy and open interpretation. But we do have things like we have cycles and waves. We have Elliott wave patterns. We have Gann fans. We have all of these other types of applications that we can put on charts. But me, again, I believe in support and resistance and chart patterns. Now, most traders instantly think of a price chart like the one that we just looked at when someone mentions the word technical analysis. Price charts provide us with an amazing amount of useful data that points and paints a complete picture of the market's historical and current supply and demand, as well as price levels that the market participants have deemed the most important. So price charts are a reflection of all the market participants' beliefs about the market and the market variables. So by focusing your analysis and trading on a market's price chart, you can streamline your trading and at the same time analyze the results of everything that contributes to price movement in a market. Now, we've all heard the old adage, history tends to repeat itself. And the markets, this is very true. People don't want to believe it, but when you trade long enough and you look at price charts long enough, you see either price levels like we talked about in support and resistance, or the price levels that are important during climbs up and down. We've also talked about chart patterns. These chart patterns are repetitious. They appear in the markets so many times that we know their validity because we see them and it happens all the time. Technical analysis is a method of predicting price movement and future market trends by studying charts of past market action. Now, we talked about gold. If we saw gold the last time it was trading at 16, this route up through 1650 and saw what happened, then we go back and we look and see how it was the last time before that, which might have been a month or two ago. We look at how it was 2 years ago when it was this level. Okay. These are all the historic price levels that we look at the history of that price, because that price is really the psychological phenomenon of what's happening to all the traders in the market. So one major advantage of technical analysis is that experienced analysts can follow many markets and market instruments simultaneously. Now, there are 5 categories in technical analysis theory: reading price charts, like we talked about candlesticks. We didn't talk about bar charts that much, but when you learn about charts, you'll understand the differences. We talked about trends and trend lines, understanding trends and trend. We've talked about interpreting price patterns like triangles. Then we have indicators, which we really haven't gotten to yet. And then we have number theory, which is like Fibonacci levels, Gann numbers, waves. Okay. And these are the main sectors that technical analysis encompasses. Now, this is a fairly easy level to deal with. This, again, is fairly easy for anybody to observe and learn and understand. Okay. Chart patterns are visual. Okay, I only trade breakouts. I don't get involved in all the characteristics and all. I trade breakouts. It's a very simplistic way of looking at patterns. But patterns are also very easy because there's only a handful of them. Under triangles, we may have an ascending, a descending, and symmetrical, but there's only 3. We have a bull pennant and a bear pennant. We have a bull flag and a bear. We have cup and handle. We have head and shoulder, but that's it. Yes, there's gurus out there that have come up. I saw one the other day called flying saucers, but these are somebody's own unique thing. These are not standard market things. Then we come up and we come to some very odd mathematical things that fall under number theory. Okay. Now, fib levels, fib retracements, very popular. A lot of people like Gann fans, a lot of people like waves, but they're complex. They take a lot of time and effort to learn and master. And then we have indicators and oscillators, which are also difficult to master, unfortunately, because they're easy today to drop on your price chart. And there's some basic standards, like when RSI or MACD breaks 80, it's overbought, so people assume it's time to sell, or when it's under 20. And they apply them very simply, and they never learn how to really use them. But learning oscillators and indicators is quite complex because you need to understand not the math, but you have to understand where all the lines come from. You can't just blindly drop something on a chart and then trade with it. But you don't have to master them all. You can master just Bollinger Bands, or you can master MACD. Like, my only indicator that I really ever use is MACD. It's my favorite. And an indicator is just what it says. It's an indicator. It indicates. It's like an interpreter for the markets. When your price on your chart isn't telling you, is confusing a little bit, and your trend lines aren't telling you what to do, and your chart patterns aren't too distinct, you might use an indicator to interpret the market. Okay. So imagine, you're at the UN and you speak, say you're from Belgium and you speak French in Belgium. And the speaker at the UN is from France, speaks French, French from France. And he's speaking on a very complex subject. Now, even though you understand French, you may put on your headset because you need an interpreter to help you get the fine little innuendo, to help you understand exactly, so you're not misunderstanding a word here and a word there. It's like, an American trying to talk to a person in the UK. We have different cultural meanings. We have different words that mean different things. So indicators can work as your interpreters. And then, of course, like I said, we have number theory. Lots of people like waves and cycles, but they think they can master them in no time flat. They take a lot of experience and understanding, but they are very helpful once you have comprehended them. So if we think of price or price chart, it's just a pictorial history of the journey of price. So if the objective is to predict the future price, then it makes sense to focus on price movements. Now, price tells us the prior action to and after important events, tells us the past and present volatility, gives us historic volume and trading levels, and gives the relative strength of a security versus the overall market. Price charts will help us assist us with an entry point. And like I mentioned, there's line charts, bar charts, and candlestick charts. Now, candlestick charts are the most popular of all three major charts as such. They are a type you see most often when you trade, and they are also a type I recommend you use when you learn to trade price action strategies. Now, we do have candlesticks overflow into every area of technical analysis because the first thing we have is we have a candlestick chart. That's just charting. But from there, we go over to reading candlesticks. Okay, those are understanding the patterns of single patterns, double patterns, three patterns, understanding the wick, and the body, knowing what a doji is or a Hammurabi or what a Marubozu is. These are all part of candlesticks that are not part of charting. They're reading price action on a charts. We can also use candlesticks to help us find support and resistance by looking at the swing highs and swing lows of the candles. Now, we also mentioned chart patterns. Well, that's basically what technical analysis is all about. If a price level had a key support and resistance in the past, traders will keep an eye out for it and base their trades around it, that historical price level. Technical analysts look for similar patterns that have formed in the past and will form the trade ideas believing that price will act the same way as it did before. Spotting price chart patterns is a popular hobby amongst traders. And one of the easiest patterns to spot is, as I mentioned earlier, a triangle pattern. However, there's more than one kind of triangle to find. So, as I mentioned, we have symmetrical triangles, we have rising wedges, symmetrical triangles, bearish pennants, increasing expanded triangles, but they're all triangles. And this is a big field of technical analysis. And some are reversal patterns, some are continuation patterns. They also help us calculate our entry point or stop loss point. They'll help us calculate where our target can be. They help us with our risk management. So everything we've talked about up to this point has been basically, it's all technical analysis, but it's all been about things we do on charts that aren't part of technical indicators. But then we come to the big field that everybody wants to know about, and that is, what is a technical indicator? But as I mentioned, indicators simply indicate. So why use technical indicators? Indicators serve three broad functions: to alert, to confirm, and to predict what price might do. An indicator can act as an alert to study price action a little bit more closely. If momentum is waning, it might be a signal to watch for a break of support. Alternatively, if there's a large positive divergence building, it may serve as an alert to watch for a resistance breakout. Indicators can be used to confirm other technical analysis tools. If there's a breakout on a chart price, a corresponding moving average crossover could serve to confirm the breakout. So according to some investors and traders, indicators can be used to predict the direction of future prices. A technical indicator offers a different perspective from which we analyze price. Now, let's go back to my price chart. We have technical indicators like we see on this price chart down below, which are MACD and are stochastic, which are placed below the price chart, on the price chart, but traced below. Then we also have indicators like Bollinger Bands, which I just dropped, which is dropped on the chart over top of price action. And so there are many different types of technical indicators. Now, some we call oscillators. Okay? Oscillators, because they're bounded between two numbers and bounce. Remember, like in the old days when a radio would oscillate. So stochastics is an oscillator because if you notice, it looks just like it's a radio wave oscillating on a scope. So remember, indicators indicate. This may sound straightforward, but sometimes traders ignore the price action of security and focus solely on the indicator. Indicators filter price action with formulas. As such, they are derivatives and not a direct reflection of the price action. This should be taken into consideration when applying analysis. Any analysis of an indicator should be taken with the price action in mind. What is the indicator saying about the price action of security? Is the price action getting stronger or weaker? Even though it may be obvious when indicators generate buy and sell signals, the signal should be taken in context with other technical analysis tools. An indicator may flash a buy signal, but if the chart pattern shows a descending triangle with a series of declining peaks, it may be a false signal. Now, many traders swear by them to help with the timing of their trades and to alert them of trends. But even for an investor more focused on the underlying fundamentals of a company, learning how these indicators work can provide added conviction on new and existing trades. Now, these technical indicators measure the direction and strength of a trend. Okay, now let's back up. Indicators fall into several different primary groups, and you have to understand what groups they fall into. There's too many traders, just like I like RSI and stochastics. Well, basically, they simply duplicate each other. They really don't help you when they're together. So we have one group that's called trend indicators. These technical indicators measure the direction and strength of a trend by comparing price to an established baseline. They include moving averages, parabolic stops, MACD like moving average convergence and divergence. Then we have momentum indicators. These technical indicators may identify the speed of price movement by comparing the current and closing price of previous moves. Now you have to remember, in all technical analysis, we only have 5 pieces of information or 5 pieces of data that we can use. Everything is based on the open, the high, the low, the close, and possibly volume. Outside of that, there's all statistical mathematical formulas, but the data that we're putting in comes from the same place. So all of these indicators just shake up that data to give it to us differently. And that's why using indicators to tell you the same thing when they're using the same data, and their formulas only give you trend information, that you're just wasting your time. So we need to combine them together. So we have a trend indicator, then we have momentum indicators. These include things like stochastics, commodities trend relative strength index. They tell us the momentum of a price movement. So if you see a trend and you have indicators telling you have an uptrend, well, the next thing you might want to add on to is a momentum indicator to tell you how strong that strength is. What is the momentum behind that move? Then we have volatility indicators. These technical indicators measure the rate of the price movement regardless of the direction. So if we see price moving up on a trend line, we see it has momentum. We also want to see how volatile, what the speed is. And then we have volume indicators. These technical indicators measure the strength of a trend based on the volume. So oscillators are the most reliable in periods when there is no clear trend in the market. Prices are moving sideways in a narrow range between particular support and resistance levels. As such, an environment oscillator can yield quite precise buy and sell, because what they'll do is an oscillator or those indicators that fall into the field of will tell you when the market is moving out of that sideways congestion. And then we know if the market was stuck at gold at 1649, 1649, 1649.50, 1649, 1649.50, 1649, and just stuck there. Okay. An oscillator will tell us that when gold is about to break up or down. Not sure, but it's going to tell you that, okay, we have something ready to break. Now, however, problems come when the market moves in certain directions and is breached and a new trend emerges. Sometimes indicators and oscillators don't work so great. And by knowing them intricately and knowing the mathematics, knowing exactly what the lines, you can then see when they'll work or isolate which ones will work best at what times. Now, technical analysts consider the market to be 80% psychological and 20% logical. Fundamental analysts consider the market to be 20% psychological and 80% logical. Psychological random may be open to debate, but there is no question the current price of a security. This price is the only thing that is accurate. After all, it's available for all to see and nobody doubts its legitimacy. Now, my firm belief is the markets are completely random. Totally. They're all about human beings making decisions, and price is completely random. But there are certain times that the markets take on a non-random behavior. When this non-random behavior occurs, and these are for short periods of time, we can then interpret what the market's going to do. So we want to be able to locate these non-random times in the market, which we could call trends or trend lines. And when we have a clear, distinct trend, we have a period of non-randomness that we can then apply a set of factors to make smart trading decisions. Now, even though there are some universal principles and rules that can be applied, it must be remembered that technical analysis is more of an art form than a science, as an art form is subject to interpretation. However, it is also flexible in its approach, and each investor should use only that which suits his or her style. Developing a style takes time, effort, dedication, but the rewards can be significant. So remember, technical analysis answers some important questions. What is the price? Where has it been? And where it should be going? So that's it for our basics of technical analysis. Thank you very much. If you want to learn more about technical analysis, if you go to www.legacyfx.com, go over their education section. They have recordings, videos, ebooks, articles, everything you want to know to understand technical analysis. And then they have all the supporting material on every type of indicator and how to do trend lines, what are price action, what are price patterns. Everything you want to know is available for you to learn. Whether you're a beginner or a professional, there's going to be information and strategies there for you. So thank you very much for joining us today, and have a great trading week. Bye now.